Good day. Back to the classroom. I think by now you could have gotten an idea this got to be a very interesting subject which would actually require a lot of focus on your part as well. It's not a joke. It's a subject of finance. It's a subject on investment analysis. And we need to really start thinking what are we doing and why are we doing all this. We're doing this for future investments and the returns expected. And we looked at the capital asset pricing model and the relationship with betas. Beta's name came up for the first time to be understood as the benchmark or the measure for finding out if you're getting good returns and got good, safe investments in your portfolios. And that would mean requiring a rate of return on an asset which is composed of risk-free rate and risk premium. So you would be able to get something good into your portfolios by choice, by deciding what is going to be the return on these investments based on decisions, looking at their betas being greater than 1 or betas being less than 1. That would be the greater the systematic risk, the greater the required rate of return, and that is what we focused on. We were looking at the estimation of the security market line. This is a little bit different than the capital market line, and we're talking about specific scripts in which the treasury bill rates are used to estimate the risk-free returns plus the expected market being unobservable. There is difficulty in understanding what are going to be the basic assumptions on understanding stock market returns, but estimating individual securities, the individual betas of securities is rather difficult, and only company-specific factors is there in the capital asset pricing model, which requires asset-specific forecast. So the security market line is good for estimating specific securities returns as being able to be compared with betas of the market, while the capital market line was more towards the macro levels. Now, estimating betas that can be looked at through market models or the characteristic line. Market model would mean relating the return on each stock in relationship to the returns of the total market, assuming a linear relationship. In the linear relationship, we can also look at the characteristic line, which would be a line fitting to the total returns for a security relative to total returns of the market index. That is how you would be able to estimate betas. Estimating betas is a little bit difficult because estimating betas requires a lot of skill in understanding the entire market in relationship to individual stocks, and probably sometimes these expectations can maybe not be as reliable as one might think. So we have to look at other matters as well and find out how accurate a beta really is. How accurate is a beta's estimate depends on changes. Betas keep changing with companies' situations. Betas keep changing, which means that they're not stationary at any given time. Over a period of time, betas will change. Betas will be about future. So estimating a future beta, it may differ from exact historical betas. The actual result sometimes differs from all the historical data we have, but we base all our assumptions on historical data. So the total of all marketable assets in the economy have to be looked at, approximated with a stock market index, and approximates return on all common stocks. Beta estimates are at best a good decision-making index, so that there is a problem in how accurate can beta estimates be. No one correct number of observations and the time periods for calculating betas, plus the regression calculations of the true alphas and betas from the characteristics line are the subject of estimation error. Portfolio betas more reliable than individual security betas, meaning it is easier to understand portfolios through betas than trying to understand and evaluate companies based on betas, but betas is a good measure of individual securities in comparison with market betas or portfolio betas. Since we have to look at evaluations, since we have to look at what the expected returns are and what realized returns are, betas is a good benchmark. Betas helps us in deciding what to get into the portfolio and what to avoid. We talked about the capital asset pricing model. How about a little bit on arbitrage pricing theory, and it's based on the law of one price. One price, but different areas. One price, different markets. One price, different exchanges. Two otherwise identical assets cannot sell at different prices. Equilibrium prices adjust to eliminate all arbitrage opportunities. Arbitrage opportunities only arise in discrepancies. Unlike capital asset pricing model, arbitrage pricing theory does not assume. It is a single period investment horizon, absence of personal taxes are taken into account, riskless borrowing or lending, mean variance decisions are all things that are included when we're talking about arbitrage pricing theory in comparison with the capital asset pricing model. There are factors to be looked at. Factors assume returns generated by a factor model. Then what are the factor characteristics? The factor characteristics are each risk must have a pervasive influence on stock returns. That is factor one. Then there are risk factors that have to be looked at. Risk factors influence expected return, have a non-zero price. Another factor characteristic is that risk factors must be unpredictable to the market. Of course, risk is unpredictable, risk is unavoidable, but risk is manageable. We are talking about managing risk, we are managing a portfolio. When we are managing a portfolio, obviously we have to look at the risk factor. So we look at the different factor characteristics. If we look at the arbitrage pricing model, we look at the most important ones, and the most important are the deviations of the factor from their expected values. We're talking about the mean, we're talking about the expectations, but realized results being different from the mean, deviating from the norm. The expected return risk has to be looked at, and we looked at the risk premium for factor, the risk premium for factor 2, and risk premium for a number of other factors. So you have to look at the different factors, which would be risk factors, when we're talking about the expected return risk relationship for the arbitrage pricing theory. These factors will be able to influence the expected and realized results in a different way, because realized results may differ on different deviations of the factors. There are problems with the arbitrage pricing theory. One of the factors is that factors are not well specified ex ante. Since factors are not well specified, therefore, to implement the APT model, it is needed that the factors that account for the differences among security returns. Capital asset pricing model identifies market portfolio as a single factor. Neither capital asset pricing model or the arbitrage pricing theory has been proven superior over each other, but can be complemented as being the same value to portfolio management theories. Both rely on unobservable expectations. It's not just the capital asset pricing model, it's not just the arbitrage pricing theory, it's not anything that can actually rely not on unobservable matters. Everything is about the future. Portfolio management, on the other hand, would require decisions that must be made by each and every investor, whether he is actively managing the portfolio process or passively managing the portfolio. A decision has to be made, and there are relationships between various investment alternatives that must be considered if an investor is to hold on to an optimal portfolio. The optimal portfolio would be a portfolio giving you the best risk-return relationship, with returns outweighing risk by a good margin. This is important for us to understand that portfolio has to be managed, cannot be set aside, cannot be ignored, but whether you're doing it actively or passively, the management process has to be there. The management process has a definite structure which everyone can follow. It integrates a set of activities in logical and orderly manner. The process is continuous and systematic. It encompasses all portfolio investments. With a structured process, anyone can execute decisions for investors, meaning an asset manager will have ease of execution as far as an investor's expectations are concerned. The investor would then not be in a worry because since procedures has explicitly been defined, then anybody managing a portfolio would not have to make any assumptions or personal decisions. There are objectives, there are constraints, there are preferences. These all have to be identified. This leads to explicit investment policies, which is a very, very good thing as far as portfolio management is concerned. These strategies developed are then implemented, and then market conditions, asset mix, and investor circumstances are continuously monitored. These monitoring procedures will help results in a much better way. Portfolio adjustments are frequently made looking at individual circumstances of an investor and changes happening to their required rate of returns, and then you can blend the portfolio, make adjustment, change the proportions in the set defined principles, the procedures, and then get on with a better result. We also have to look at the individual and institutional investors, and in the institutional investor we found that there were many advantages. They being bigger, they maintained relatively constant profile over time. They have legal and regulatory constraints, though where to invest and where not to, but they have well-defined and effective policies, and that is very critical. And the individual investors, they have life stage matters, they have risk in losing money, that is very important, and then it is characterized by individual personalities as well. And for them, there is a specific goal. The goal, obviously, the objective, obviously, the end result objectively is making good money, making a return on the principal amount they might have invested into the portfolio or individual stock. It is the goal that they look at. The primary reason for establishing a long-term investment policy is the key for an investor, which is institutional investor. An institutional investor goes for the long term. An individual investor probably might not be able to do that. But an institutional investor prevents arbitrary decisions, arbitrary revisions of a soundly designed investment policy. That is something like thinking before you leap, making plans before you invest. So it helps portfolio managers to plan and execute on a long-term basis. What does it do? It helps eliminate short-term pressures. It helps eliminate short-term discrepancies. It helps eliminate short-term panics and any untoward instances related to short-term issues in the capital market. Capital market returns are looked at by understanding the life cycle approach, which would be the risk return position at various life cycle stages. If you look at the graph, you'll be able to see the ABC of risk return, the straight blue line, which will tell you that A is the accumulation phase, early career, consolidation phase would be for the mid to later careers, and spending phase would be spending and gifting phase, the senior citizen age. You spend a good, robust life, enjoyed the fruits of benefit of hard labor, hard work, and then you look at a safer return. Whereas in the earlier career, you're a bit more adventurous, are willing to take more risk. Obviously, that will be in proportion to the returns. You'll be able to have a good risk-return relationship, but generally speaking, a mid to late career would be the best option, keeping a middle of the line. Now, when we're looking at the life cycle approach, talking about different ages, talking about different requirements, talking about different levels of risk, we need to get on to the conclusion of how to make an investment policy. What sort of investment policy do we need to formulate? Investment policy summarizes the objectives. It summarizes the constraints. It summarizes the preferences of the investor. But there is certain investor information that's required, there's certain market information that's required for the objectives. The objectives that are needed for, because you need the information, are the return requirements and how much is the risk tolerance. The key word is risk tolerance and return requirements. That is the key to investment policy decision making. There are constraints, there are preferences, but we need to understand that one of them could be liquidity, time period could be another, laws and regulations could be just more, taxes, unique preferences. There are a number of constraints, there are a number of preferences. You have personal likings and dislikings for stocks. You have personal likings and dislikings for certain industries. You are not very comfortable with certain industries because of a particular reason, or you've had a bad experience with the industry, you don't like it. You have personal preferences. Maybe there are taxes that you have to look at, the returns that you look at. Sometimes you're worried about double taxation on the industry's end, and then yourself getting taxed as well. Somebody is interested in scripts that might give you dividends, which would be double taxation. Somebody would want a stock dividend, which would be devoid of any taxation issues. There are constraints, there are preferences. Objectives are how much money to make within how much time. When you're talking about horizon and returns, it is important for us to look at the age objectives and find out what the requirements are, and that is why information is needed before you formulate an investment policy. Because once you have really tailor-made an investment policy, you have to look into the account that is what the required returns are expected from the investor. Since you're looking and managing portfolios for other people, or if you're making a portfolio for your own use, there are certain informations that you need to look into before you actually make a decision on what sort of a portfolio would you want to be taken into account. While we were talking about formulating investment policies, we understand we also look into the aspect of the investment policy that should be able to contain a statement about inflation. We must look at inflation. We're looking at a time horizon. Inflation has to be taken into account, and then we have to adjust returns in line with the inflation. Inflation happens over time. So since we're talking about time horizons, we must understand that we have to adjust prices along with inflation. Clearly, this is a problem for investors. Clearly, common stocks are not always on inflation hedge, but there are unique needs and circumstances. May restrict certain asset classes. You may not want fixed income. You may not want variable income. You may be more comfortable with a riskless investment, but then the returns would not be as good as you would want. But if you are looking into safe investments, there will be constraints. The individual investors will have their personal likings and dislikings that have to be looked at. Certain asset classes, like risky assets or riskless assets, have to be looked at. The preferences are there when you're making investment policies. You have to understand that portfolios have to be built looking at the greater interest of an individual. That is why there are a number of assets, there are a number of management assets, there are a number of portfolios that can be designed based on personal constraints or personal preferences. But these are informations that are required before you can actually make a portfolio. We need to understand that these investment decisions are going to be quite long-term investment decisions. These are not trading decisions, these are investment decisions. Once again, we must focus on the terms investment and trading. We're not talking about trading, we're talking about investment. Investment is for the long term. And when looking at the time horizon, we're looking at inflation, and then we have to adjust our strategy, adjust our prices, adjust our returns along with inflation. Common stocks are not always an inflationary hedge. Commodities may be, foreign currencies may be, global investments may be, but definitely not common stocks. Except when you get good capital returns and dividend yields are good. If you would look at the constraints if we were to look at the preferences, we would understand, one, it's about time horizon. How much period do you have? How much time are you willing to give to the portfolio to mature? There is a maturity level. We're not talking about maturity as in bonds. We're talking about maturity in portfolios. So you have to look at what sort of a time horizon you have. And we looked at the graph where you saw A, B, C depicting senior citizen, mid-careers, and early starters having different levels of risk and willing to give more or less time horizons to their investments. There are also, these are the objectives that may require specific planning horizons. Liquidity problems could be another thing that you need to look at. This is a serious problem, and there are liquidity needs for every individual. So investors should know what sort of future cash flows are required by them. You must know, because you can't just pluck out funds, you just can't ruin the portfolio by using funds that you hadn't accounted for at the start of the investment. You have to have spare cash available to you over a period of time that you're going to invest into the portfolio. The tax considerations that you have to look at: can you afford the taxes? Are you going into a bracket that's going to give you a lot of tax? So ordinary income tax has to be looked at versus capital gains. But retirement programs are there offering tax shelters, pension funds. But getting back to inflation, getting back to capital gain versus taxes, capital gain certainly sometimes outweighs taxes, and taxes then become meaningless. Because capital gains and income tax would be very different, because ordinary income would be definitely not very welcome than capital gains. The capital gains is definitely what we're actually looking at when we're talking about capital markets. Capital gains can be phenomenal. We're not talking about returns on investment. We're talking about interest or dividends on your stocks. We're talking about big jumps in the prices of the stocks. The capital gain on a portfolio or an individual will outweigh all normal average incomes. There are also legal and regulatory requirements for each investment policy decision that you make. There are definite constraints and inhibitions and restraints on behalf of the legalities and regulatory bodies. The prudent man rule followed in fiduciary responsibility. People who are in the regulatory sector, people are having a fiduciary responsibility. The interpretation can change with time and circumstances. Also, we had to look at the standards applied to individual investments rather than a portfolio as a whole. These will be all different things. So there has to be diversification. There has to be standards applied to the entire portfolio. The proportional fit, the blend between value and growth investments, fixed income, variable income, equity income, bond income, or maybe derivatives in the portfolio. This now is another word that I'm going to talk to you about in a later while, maybe in the next lecture or so, is derivatives, which is a combination of futures, options, swaps, and swaptions can be put into the portfolio as well. You're trying to build an optimal portfolio. You can put in any number of products in a certain percentage to get the best optimal result for your portfolios and manage it well. But we need to understand futures in a big way. Futures is something new, but right now we're talking about regulatory and legal requirements. So we have to look at the constraints and preferences, the legal requirements, the regulatory requirements, who can abstain, who can work, who can build up a portfolio, is he competent enough, is he qualified enough, can you look into a good estimate for the future? Can you read the balance sheets? Can you read the charts? Can you read the writing on the walls? Can you look at the political risk? Can you look at the market risk? You have to understand all this. So that would be what then? The prudent man rule. Being very safe, being a good decision maker, and deciding into investing nicely to make a good portfolio. Also, we must understand when we look at portfolios, we're not looking at individual scripts. We are in fact looking at scripts inside the portfolio and looking at the portfolio as a single unit. There are expectations on behalf of the investor. There are expectations from the individual investor. There are expectations from the institutional investor. There are capital market expectations. What are these capital market expectations? One, there are macro factors. In the bigger picture, bigger canvas, we look at expectations about the entire capital market and how the behavior and performance of the entire capital market will be. Since we're talking about portfolio manager and portfolios are built up or from within the capital market, we have to look at the macro picture and understand the expectations about the capital markets. How about micro factors? Micro factors would be estimating that influence the selection of a particular asset for the particular portfolio. It's about particular assets, it's about particular portfolios, it's about specific assets for specific portfolios, and we're talking about the influence and estimating the influence focused on the portfolio. Macro, micro would then lead to rate of return assumptions. The rate of return, the ROR, is important as far as returns are considered. We're talking about we're not having to do anything with less than expectation. We have to have a good return. Good returns will happen with good portfolios, and rate of return assumptions should be realistic. Fantasies of making it rich in one day are just stories that you look at. That's all in the movies, doesn't happen in the stock market. In real life, you don't become rich overnight. So, have to be realistic. The rate of returns have to be realistic, more in line to what life really is, and then study historical returns carefully. Remember, when we're talking about quantitative and qualitative assumptions, or quantitative and qualitative data, or empirical data, we must understand all our assumptions are based on historical data. These historical data will provide you the insight to look into, peep into the future, but may not be the same as you have configured, would result in a different way. Although history is there, historical data is there, and history does repeat itself, but it doesn't repeat in the same way. So, historical results could replicate, but maybe in a different way. But history is the only thing that we can rely on and having something of value on which to decide what sort of return we are going to get in future. There are rate of returns assumptions. We must understand that these rate of return assumptions are to be understood. How much influence should recent stock market returns have? The question really is that if you have to look at the stock market, the capital market, and then the portfolio, we must understand there has to be certain influence that has to be noticed, and how much influence should recent stock market returns have on the rate of return. Mean reversion arguments. Stock market returns involve risk. Considerable amount of risk is involved in understanding the rate of return. Probability of 10% return is 50% regardless of the holding period. Probability of greater than 10% return decreases over long investment horizons. Expected returns are never guaranteed. Nobody talks about guarantee. People do tend to talk to me about the word guarantee being in our local stock exchanges. The Lahore Stock Exchange Guarantee Limited, the Karachi Stock Exchange Guarantee Limited, the Islamic Stock Exchange Guarantee Limited. The guarantee has got nothing to do with returns. It is a type of a company, and it doesn't guarantee you specific returns. We're generally speaking of realistic returns, and we're generally talking about returns ahead of inflation, the required rate of return, the return that's needed, looking at risk-free borrowing and lending, and we look at the required rate of return being realistic. To be realistic, we must look at history and find out what the rate of returns have been. And to understand that, we have to look at what would be an optimal return for investments. In some stock exchanges, 10% would be good. In others, with high inflation, even 20% would be little. It all depends on personal preferences, but we have to be realistic in understanding what have been the average returns of the entire market, or the average returns based on an index, or the average returns of a similar portfolio of a similar size over a single time horizon. and then be able to compare if doing well or not. All this study is revolving around a portfolio and how are we going to construct the portfolio, because we're talking about constructing an optimal portfolio for good optimal returns. Turning a square into a circle or trying to turn a circle into a square is difficult, but to construct a portfolio, we need to understand and use an investment policy and capital market expectations to choose portfolios of assets that have to be included into a portfolio. We define securities that are eligible for inclusion in a particular portfolio. Remember, we're talking about particular portfolios, specific portfolios, because we're going to have different kinds of portfolios. Each portfolio's requirement is different from the other. Keep in mind the time horizon, the requirements of senior citizens, the mid-career people, and the youngsters. So you need to construct a portfolio which would be different from each category. Use an optimization procedure to select securities and determine the proper portfolio weightage, the proportions that have to be looked into when you're constructing a portfolio. Who helps us here? Who helps us construct the portfolio much better than nobody else but the Markowitz model? That is a formal model that helps us in constructing a portfolio. So, Markowitz provides a formal model in making you decide what sort of an asset mix there should be based on the proportion and the procedure to select the correct securities. This defines securities eligible for inclusion in a particular portfolio. This construction of portfolio will go a long way in getting the results that you require eventually that will help you make a good investment decision based on constructing the portfolio and using investment policies and capital market expectations that would make you choose portfolios of assets to be included while constructing a portfolio. This, since is a numbers game, this since is all about looking at capital gains or looking at returns, required rate of returns over a time horizon. You look at the best possible fits coming into the portfolio, and that is why we need to have an investment policy before we construct the portfolio. There has to be a different allocation for different specific assets. All assets have their own characteristics. All assets have their own market dependability. All assets have their own ability to follow the market, the trends of the market. The capital market line will then maybe dictate the security market line, because individual securities tend to be a part of the trend. Asset allocation will then help you involve making a decision on weights for cash, bonds, stocks, foreign exchange, derivatives. It depends what sort of an asset mix you're going to have in the portfolio. One of the most important decisions to make in portfolio construction is that there are differences in allocation cause differences in portfolio performance. It will all depend on the person who's constructing the portfolio. Portfolio is something like a computer. Garbage in, garbage out. It will not do anything on its own. It's going to behave the way you made it to behave. So the decisions you make in portfolio construction will let you get back to you the way you put things inside the portfolio. The results are going to be the same. Factors that you need to consider. You need to consider return requirements. I said it before, say it again. The requirement needs that you need to understand. Tolerance in facing risk. How much patience do you have? How much risk are you willing to take? How much patience do you have regarding time horizon? How long are you going to wait for the fruit to ripe? Age of the investor, requirements, needs, risk, capacity to take risk, capacity to weather storms, wait it out. The longer the better. Buy and hold. You have to find out requirements. You have to make a blend. You can make an aggressive portfolio, build up of only shares. You can make up a milder portfolio, blending stocks and bonds. You can make it more diversifiable by putting in stocks, bonds, cash, near-term cash, pure liquid cash for any eventuality. Of course, that cash is not parked anywhere else but in places where there would be returns. Once again, there'll have to be preferences that you'll have to take into account. Maybe people are not comfortable by you using cash and putting into banks. Maybe they'll have to look in for another portfolio, because bank returns might not be the optimal way of getting good return onto your portfolio. Asset allocation has to be looked into very seriously, because it's the assets that are going to produce results. There is the strategic asset allocation, or you could go for a tactical asset allocation. It all depends on you. Strategic asset allocation will help you in making a portfolio with simulation procedures. You will make simulation procedures used to determine likely range of outcomes associated with each asset mix. This establishes long-run strategic asset mixes. You could maybe, try it out before you do the actual stuff. You do it before you make the portfolio. You would have a tactical asset allocation. Changes in asset mix driven by changes in expected results as and when required. Market timings is another way you can help in the tactical asset allocation. You keep moving in and out of a script, out of an asset. You swap from one asset to another, not very frequently, but then asset allocation plays a role. Asset management then takes over, and then you can maybe actively manage the asset or passively manage the asset. Will depend basically on what the initial investment asset allocations were. The asset allocation at the outset will determine the results in future. So if you're going for tactical asset allocation, you may want to swap, you may want to switch over to a better product, a less riskier product, a more gainful product. Will depend on market conditions, will depend on capital market conditions, will depend on inflation, will depend on risk, will depend on interest rate, will depend on foreign exchange, will depend on anything. The macros will affect micros, and micros will then affect the portfolio results. So asset allocation is also very important when you're talking about constructing a portfolio. Now you're talking about portfolio constructions, you're talking about asset allocation, we're talking about deciding what to put into. We also need to do all that and then eventually monitor conditions and circumstances. When I'm talking about monitoring conditions and looking at circumstances, we're talking about macro stuff. We're talking about the overall external environments. We're talking about the risks, the factors for which we may not have control or may have control. Investor circumstances can change for several reasons, can change over time. Emergencies can occur. The plans can be disturbed. Immediate cash flow requirements would want to be bailed out from the portfolio. There are a number of things that you need to look at. Wealth changes affect risk tolerance. The individual investor might have certain setbacks, and that change in wealth will affect risk tolerance. He might not be in a capacity to take any more risk. Investment horizon changes. Liquidity requirement changes. Tax circumstances change. Regulatory considerations have to be taken into account. Unique needs and circumstances may arise. These are just a few that I've mentioned. There will be a number of more individual specific requirements of an individual investor. We are talking about monitoring circumstances. We're talking about monitoring the actualities at the scene of the crime. We're talking about different aspects that you need to look at when we're talking about monitoring portfolios as well. Because the only thing that's not going to be the same is going to be time, because time keeps changing. You need to understand that you need to be making changes in portfolios all the time, even if you do not want to. It is a job that you must be good at, because you've got to go with the trend. You've got to go and adjust yourself with circumstances and country conditions as well, and market conditions as well. So there are portfolio adjustments that you need to do. These portfolio adjustments are going to help you get a better result from the portfolio. Portfolio is not intended to stay fixed. There's no rule that you cannot change a portfolio. There's no rule that you cannot change the products in the portfolio. There's no rule that you can keep a shift between assets. There's also probability of shift in proportions. The key is to know when to do it. One of the more important things in the capital market is the word called time. Key is to success. The key to success is to know when to rebalance, to reallocate, to reproportionate. You have to make adjustments at the right time. But rebalancing involves cost. The rebalancing cost involves brokerage commissions. Every time you buy and sell, you have a commission to pay. Rebalancing cost involves possible impact of trade on market price. You might end up worse state of affairs by rebalancing into something which maybe not do as well as the original asset. Rebalancing cost involves time involved in deciding to trade. These are all negativities that we need to look at while talking about portfolio adjustments. Cost of not rebalancing involves holding unfavorable positions. There are so good factors for portfolio adjustments and bad aspects too as well. If you're going to be talking about cost of not rebalancing, you might just be watering the weeds. So instead of watering the weeds, what we need to do is pluck out the weeds and water the plants. In doing that, we need to pluck out the non-performers and put out potential performers into the portfolio. We might be able to achieve what we have actually planned, but that will be only determined when the time of maturity comes for the portfolio. But then, if you do a rebalancing act, will involve more cost in selling and buying, possible impact of trading and the difference in buying and selling, and maybe the time factor might hurt the rebalancing act in itself. So while rebalancing might not be a good idea, then again rebalancing would be a good idea as well. It's all about making the right decision at the right time. To do all that, to understand whether you've made a good decision or not, we have to look at the way you have performed. In doing that, we need to understand a certain thing called performance measurement. And by managing your performance, you are then able to measure it. We need to understand the management, the levels at which you've earned anything for the portfolio. The performance measurement is important when you understand that it allows measurement of the success of the portfolio manager and the success of the portfolio being managed. The key part of monitoring strategy and evaluating risks that are important for those who employ an asset manager or a portfolio manager, or for those who invest personal funds. To find reasons for success or failure, that's what we'll be able to do when we're doing performance measurement. Why and how did we fail? Why and how did we fare? And why and how we succeeded have all to do with performance measurement. In doing performance measurement, we need to understand, we need to do this in understanding the objectives of performance. Why did we construct a portfolio? Why did we invest in the portfolio? Would then be understood by realizing, well, there was a goal to be, achieved. The performance measurement is going to do just that in looking at the event, whether a goal has been achieved or whether it has not been achieved. The performance measurement is important for us to understand. It's something for us to find out whether it failed or succeeded. If we do not do that, what's the point in investing for the future if we do not know how we've done? And we actually do that. How should portfolio performance be evaluated then? What things have to be looked at when talking about evaluation? The bottom line. That is the bottom line issue in investing. Why did we invest in the first place if we're not going to measure what we've gotten into? So the bottom line issue in investing is how performance was. How did you perform well or not? Is the return after all expenses adequate compensation for the risk you took in investing? It's a relationship between return and risk that has to be evaluated. What changes should be made if the compensation was too small? For the next time, that is. And whether the performance must be evaluated before answering these questions. The performance is one of the prime reasons for us to be happy about whether we've done a job well. It's a job well done. It's a portfolio well managed. It's a good job for the manager to be looking after another portfolio, whether another asset manager should be found, whether it's a good idea to invest in a particular performance measured portfolio, whether there was optimal return in this sort of an investment. These are things, because it's not going to be a one-time investment when talking about capital markets. Capital market investment is going to be more than one time. So there is always time for any individual to rectify the mistakes, if there are any. We do not doubt the fact that you're not going to have a perfect honeymoon while talking about investing in capital markets, but we can always look for better returns in the future based on our performances. The evaluation of the investment process is going to be very important if we are to make any meaningful investment decision for the future. The reason why we must understand how to evaluate portfolios or how to measure the performance of the portfolio. The bottom line, that is always the question that everybody wants to know. What have been the earnings? What are the potentials? Where did anything go wrong? What are things that need to be improved for the next time? Because we'll have another time, another day. The market is not going anywhere. We are supposed to be surviving any eventuality to understand that markets will be there. It's for us to be available when we need to understand that if we are in a good shape economically, we'll be able to deal with the market again in a better way. But for that, you need to evaluate the performance. Whenever we are into a college, whenever we are into academics, every student gets an evaluation. You get evaluated yourself through grade point averages, through percentages, through divisions, and then you know through smaller evaluations what hangs in the future in a bigger evaluation. So maybe you have periodical quizzes or tests, you have monthly tests or quizzes, but that will gear you up to evaluate your performance in academics, which will make you ready for the big day. The final examination, the final term papers will be a test based on your regular assignments. Similarly, portfolio can be measured in the same way by doing regular periodic measurements so that at the end of the day you're able to look back and enjoy what sort of good investment decision you eventually made. Will depend on what your returns were and whether the risk you took was worth it or not. Risk, the word of risk will always keep coming to haunt you. The risk word is going to be there when we talk about capital markets. So we must understand what are the returns that we got when we took such a risk. And since returns has to be better than the risk, it's always a good idea to do a performance evaluation of the investments that have been done. Thank you very much.